Good morning, everyone. It's February the 2nd, Monday. Welcome to 7investing Live. This is our show where we spotlight and put a lot of attention on some of the stock market's most intriguing opportunities. We're so glad you're here. We film every Monday, Wednesday, and Friday at 10 a.m. Eastern Time. My name is Simon Erickson. Welcome to the show. I'm the founder and CEO of 7investing, and happy Groundhog Day to you. I feel like it's only appropriate to start the show by mentioning that Punxsutawney Phil, the famous rat up in Punxsutawney, Pennsylvania, did in fact see his shadow this morning. Unfortunately, yes, that means there are going to be 6 more weeks of winter. There's a picture of Phil. You can see him. He's been doing this for how many decades now? Literally the groundhog up in Pennsylvania saw a shadow. We're due for 6 more weeks of winter. I'm sorry, everyone. Phil's decision has been made. But there is a bright light that might still come from this, and that is the consumer discretionary sector, which is what we're going to be talking about here this morning. Even though we might be due for more cold weather, this is a sector that is truly heating up. And we're going to talk about consumer discretionary, what that means, how it fits into the S&P first and foremost. And then also, secondly, we're going to be talking about kind of why has the past 5 years been difficult for this sector. And then also looking at the drivers going forward. But what is consumer discretion? Let's start first and foremost talking about what this sector even means. It kind of describes the things that we spend money on that we don't necessarily need, right? It's not consumer staples. This is not, milk and eggs and cereal, which is its own category. This is the part of the consumer wallet and spend that is not absolutely necessary for daily life, including capybara stuffed animals that might be mistaken as groundhogs. This is consumer discretionary within this S&P 500. It's kind of got its own thing. We can look at some of the charts of how this has looked over the last couple of years. First and foremost, here is one that looks at the performance of the S&P 500. They're in yellow versus the subsegment of the S&P that is dedicated for consumer discretionary. Again, market cap weighted index. This is the companies that tend to be very cyclical in nature. Look at the green line. Look at how in times where the market is strong and outperforming, consumer discretionary tends to do better than the broader market. But then when the market slows down, it tends to be a little bit more volatile and actually falls compared to the rest of the market there. And we've got one more that shows the constituents, if we can pull this one up. What are we talking about when we describe consumer discretionary? Well, these are the kind of companies that are retailers or sometimes automakers or home purchases, the companies like the Amazons of the world, Tesla, Home Depot, and Lowe's, TJ Maxx, McDonald's, the restaurants. These are the things where you can put your money to work when you want to get out of the house or you want to buy something for the house or you're looking to upgrade your vehicle or purchase something online. This is broadly what consumer discretionary refers to. And as a whole, this sector, as we mentioned, can be very, very cyclical. In fact, the last 5 years have been kind of a difficult time for the consumer discretionary sector as a whole. We've got another chart here from the Boston Consulting Group. It's kind of neat. There's some, here it is right there. You can kind of see the circles, and we can talk about total shareholder return. This is a great report that the Boston Consulting Group publishes every year at the end of the year, which talks about the drivers of shareholder return, right? It looks at all the sectors of the stock market and says, okay, what are the drivers that are putting good stocks, ahead of the market? What are the best performing constituents in the S&P 500? What are the best performing sectors of the broader market? And then why? What is driving those returns of them? And so if you look at the top part of this graph, this is from the Value Creators Index from 2025. You can see the median 5-year total shareholder return between the year 2020 and 2024. That is the y-axis at the top there. And then if we look from left to right on the x-axis there, we can see what is the median 5-year total shareholder return for the previous 5 years, right? So if you had something that was doing very well in the 5 years between 2015 and 2019, that then slowed down in the next 5 years between 2020 and 2024, that would be represented in the bottom right of this graphic, right? The total shareholder return slowdown. Stocks that did really well in the first 5 years and then slowed down the next 5. You can see medical technology, media and publishing, pharmaceuticals. This is kind of the sectors that are slowing down here recently. And then conversely, the ones that have done very well in the last 5 years, as opposed to their typical returns the 5 years before that, you see kind of oil and gas, metals, construction, a lot of these hard asset industries that have done quite well here recently. And then you kind of got the ones in the middle, especially if they're tech, hardware, and software and services. We're not surprised by this. We've seen AI and software companies, and especially the data center and the need for high performance chips and computing continue to do very well, not only in the previous 5 years, but then also in the 5 years before that as well. But I draw the attention to retail, which is kind of right there in the middle. You can kind of see, and you can see it's a large industry, right? This is a multi-trillion-dollar industry as represented in the S&P 500. And it's a little bit slower here in terms of the median 5-year return of the last 5 years, as opposed to the 5 years before that. Retail typically is kind of, 11, 12% annual return for this sector. And it's slowed down a little bit here in the recent recent time frame, right? Maybe call it about a 10% overall return, a little bit less than 10%. I think it's 9.8% annual return between 2020 and 2024. Even though, as a whole, if you look back kind of in the long-term returns of the S&P 500, this is a good sector. This is a sector that actually tends to outperform the broader S&P 500 when you look at long periods of time. And so why has retail underperformed in the last 5 years? This is not surprising to anyone. We've had a difficult go for the retail sector, consumer discretionary included. These are the things that have been impacted by COVID, where people might not be going out to eat quite as often, might not be going out to fast casual restaurants, might not even be going to bricks and mortar retailers anymore. In addition to that, we also had 2022 was a very difficult year where the Fed raised interest rates 7 times in a row, right? That might cut back on consumer spending, that might cut down on business spending. And then on top of that, here recently, we've had international tariffs, certainly pushing up the price of goods for anything that is imported into the United States. When prices go up, people tend to buy fewer things, and that could certainly impact consumer discretionary and the retail industry. So there's a look at kind of looking at not only what does consumer discretionary refer to, but why has it underperformed in the last 5 years? This is kind of a little bit of a backdrop on what's going on in this sector. But now looking forward, the stock market, of course, is always a forward-looking machine. We don't like to buy at peak enthusiasm. We don't want to buy when expectations are super high and valuations are super expensive. I am a big believer in buy low. You want to look for favors that are out of sectors that are out of favor, and then buy them when there are drivers that are going to be pushing them back into favor. And certainly for a cyclical sector like consumer discretionary, there's a lot of things that are aligning for this to outperform over the next 5 years, in my opinion. One of which is, well, before I get into the drivers, I will say one more thing on this, which is the last 5 recommendations of 7investing have been consumer-facing companies. They've not all necessarily been consumer discretionary companies, but if we broaden that to include things like advertising or consumer-facing software and retailers, 5 months in a row, I've been focused on this sector because I do believe it is one of the best and most poised for a turnaround. Let's talk about GPT for a moment here. This is a massive deal, right? Almost 1 billion users now are using the free version of ChatGPT that's available from OpenAI. And for the most part, we've only been using this for free. We've been using the free version. There are 50 million of us, about 5% of the user base that are paying the $200 a month for the pro plan for GPT. But for the most part, this has been a free service. You go and you use the dashboard, you use the interface, you ask questions, it just returns them to you. And we've gotten an announcement here about 2 weeks ago that GPT is going to start including advertising into the interface. OpenAI is now saying, yes, we've got 1 billion users, similar to what Google did before, similar to what Facebook did after them. When you get 1 billion user product, you want to start monetizing it over time. And so in addition to having a new tiered plan called GPT Go, which should be offered for $8 a month in US dollars, they're also going to be offering another free version as well, which will include ads directly into the GPT prompt. Here's an example of how they're kind of sponsoring it or thinking the sponsor is going to look. In this example, if you're not actually able to see the video, you're asking for, hey, I want some simple Mexican dish ideas for my dinner party. You can kind of see some of the ideas. And at the very bottom, boom, you've got hot sauce. You've got some ideas of products that might complement the search that you're looking for. Very, very similar to Google right here. Of course, a little bit of a different command prompt as opposed to searching web pages and then in getting results based on what you're looking for. You're actually asking directly in a conversational tone for GPT. But we're going to start seeing advertisements placed into that GPT prompt. Why is this important? Well, because, of course, the companies that are going to be placing those ads are going to be the consumer discretionary companies and the retailers. And now more than ever, they've got an opportunity to get low conversion costs and sell very efficiently whatever products or services they're selling because there's so many options available out there, right? This kind of moved first to the web where you started building apps and you would place ads within the apps. Then we would go programmatic into connected TV, things like the Trade Desk, where you'd actually see video ads out there. Of course, we're already familiar with banner ads that are following us around the internet as it was before. And then now we've got a new platform, a new form factor for these ads to be embedded within GPT for billions of people, over a billion people globally. This is really good if you're a retailer. You want to get your acquisition costs for people buying things as low as possible. That goes right through into your income statement. You now have more and more options that are available for you. And so I think that the companies that are appealing to people all around the world, international presence, have got integrated supply chains that probably over last year's tariff fiasco are becoming more efficient in 2026, at least compared to 2025. And then now you've got a lower cost of acquisition of new customers. I think this is great for consumer facing sectors. And so let's look at some of these companies that are in consumer discretionary and to look at, kind of what I see happening here in 2026. And this is the meat of the conversation that I'd like to have here today. By the way, this comes directly from our 7investing year in review. Quick promotion for that. This is something we published in the middle of December. We looked at all 17 of the market sectors that we have active recommendations on the 7investing scorecard, and consumer discretionary, one of those 17, but kind of a review, if you will, of what happened in 2025, and then what is kind of in store for 2026, and then what is our conviction for all of the recommendations we have on our scorecard. I'd really encourage you to check this out. This is one segment of the entire year in review. You can see the whole thing if you go to 7investing.com/subscribe. You get your first 7 days totally free. You get to see all the premium content, including this. If you're investing in 2026 in any market sector, this could be a very useful resource. But let's look at consumer discretionary. A quick review of some of these bullet points, right? American consumers been in a funk in 2025 for all the reasons we just mentioned. I think that big brand retailers like Nike or Lululemon have had multiple quarters of negative comps, right? Negative year-over-year sales growth and declining profit margins. But you can see a lot of these companies, they're hiring new CEOs, they're eager for a turnaround, and they also had a really difficult year in 2025, which means I think the arrow is pointing up. It's going to be a better year in terms of the year-over-year comparisons here in 2026. And then, of course, if you've got an internationally recognized brand, like a company like Crocs, and you're selling for 6 times free cash flow on a trailing basis, it could be that some of these companies are just too cheap out there to ignore. Right? At some point, if you're pricing a company at a very, very low valuation multiple, you're pricing it as though it's going to go out of business, as though there's no return. These are the companies like, the companies that just had a presence in malls or bricks and mortar retailers that didn't transition online. There's a lot of well-loved international brands that I think are very popular. They're going to turn things around next year and are just selling way too cheap. The restaurants, the consumer discretionary budget also includes things like Starbucks, things like Domino's Pizza, things like Chipotle and Cava Group. A lot of these, again, saw lower diner traffic last year, but have got excellent profit margins already. And even though it's been a challenging macro, they're pumping out free cash flow and they're returning it to shareholders through dividends and buybacks. Great time to buy back your stock when it's selling really cheap. And then you've got some other companies like DraftKings, Duolingo. These are software companies out there that have changes going on in the industries, but there's still, more than 1 billion users globally can be using products that are similar to these. In fact, both of these companies have already got more than 100 million users that are either using or paying for them right now. The fundamental results still look very good, even though there's a lot of hesitation from the market on companies like these. And last but not least, Tesla continues to be Tesla. Whether you love Elon Musk or you hate him, he has done some amazing things in the world. He is a disruptor of all market sectors, Tesla included within that. We've seen Tesla discontinuing some of its models. We've seen a new pay package for Elon that is going to keep him motivated to do amazing things with this business. It will be interesting to see the progress that Tesla continues to make on the robotaxi network within the next few years as autonomous vehicles gain acceptance in more and more cities across the United States. So Tesla's another one to keep an eye on there in consumer discretionary. This is kind of, a vignette, if you will, a sub-segment of this market sector and some of the companies that are participating in this. And again, some of these companies may or may not even be 7investing recommendations that I think are either too cheap or have got too many tailwinds behind them right now. And this brings me to the final point that I'd like to make on today's show, which is that we just released our February 2026 official recommendation yesterday. Right before Punxsutawney Phil saw his shadow, we put out our official recommendation on the first of the month, as we do on every single month out there. This is an up and comer that's not the legacy platforms or retailers or consumer facing companies out there. This is a new one that I'm very excited about what they're doing. I think they've got a really good leadership team in place, and they're making a lot of progress right now in a market sector that is kind of dominated in their sector, at least, by kind of the old guard and the legacy companies. And so it's going to be interesting to see as we're in this consumer lull. Things are a little bit slower here in 2025. Typically, you have to pay a premium for a company like this, but because again of the cyclical downturn of the consumer sector, I think we're getting a great opportunity to buy an innovator at an inexpensive valuation here in February 2026. So you can check that one out at 7investing.com/recommendations if you actually want to see the pick itself. This is where you can go and get started for 7 days, free of charge, see all the premium content, see why I'm so excited about the retail sector and consumer discretionary as we described here on this live stream. Heather, quick show today. I did want to bring you in for a couple of questions if you have any about, retail, about consumer discretionary, about Tesla, anywhere you want to go. This is kind of a broad market sector that's got a lot of different companies in it.
Sure, of course. I guess my first question would be with the ChatGPT ads, are they going to be? That one looked like it was pretty focused. It was a recipe and then it was a hot sauce. Is the plan there to be focused on what people are searching for? And does that mean that that ChatGPT can charge higher amounts for those ads versus just general ads?
Yeah, good question. They've said right now that they want to be not biased, right? There's always been as many issues about Google directing traffic to, the ones that were paying the best rates, and that wasn't really your own organic search, right? It's not meant to be another search engine that has inherent biases in the algorithms. It's meant to understand the question you are asking or the search you are conducting, and then put this non-obtrusive ad on the side out there. I don't know in terms of the pricing how it's going to look. We typically have seen a change in advertising broadly from the cost per ad for impressions shifting broadly to the cost per ad for clicks or for interactions. It'll be interesting to see how they monetize it. If it's just a matter of, hey, we're just going to put them up and see how this goes in terms of an impression rate, or they're going to actually try to get some interaction and some details on how many people are clicking on them out there. To be determined, but certainly over the next 2 or 3 months, we'll get some more data about those things.
That makes a lot of sense. Um, Outside your pick, obviously, what are some top quiet consumer discretionary companies that you're watching, not recommending, but are kind of just watching from the sidelines and are interested in right now?
I mean, one that I think is interesting, is Adobe. Adobe is more of an enterprise software, but it also is kind of that, recurring revenue. It's people using it. A lot of it is individual users or even people that are in workplaces. I mean, people are writing that off as dead because it's an AI disrupted company. You can make images anywhere. I mean, things like that. It's going to be seems like it's just too cheap right now, but its enterprise base is still going to be working with them. And then on the advertising side of it too, a little bit that's tangential, perhaps again to the consumer and discretionary budgets is a trade desk, right? The trade desk is something that is facilitating programmatic advertising, mostly on TV streaming, but also all across the internet too. If you can get ad volumes back up, ad budgets start going back up again. They were a little bit low in 2025, but if that starts picking up in 2026, you start getting the volumes, you start getting a really good take rate for that. That flows right to the bottom line really quickly. It's a stock that's really out of favor right now. If you look at the trade desk stock chart, it was fantastic, in all years up to 2025, and then it just collapsed last year. Does that mean the company is dead and we're just going to pronounce it, there's no heart rate anymore on this one? Or does it just mean that we're in a cyclical downturn right now? I think something like that could be very interesting. And then the retailers, the level retailers, like we mentioned in the previous slide, the ones that are directly, the Lululemons, the Nikes, the Crocs. I mean, these companies tend to ride out the storm like everybody else does during the downturns. But then they've got strong enough brands that they bounce back stronger when their competitors maybe fold. And so I think that lovable brands are kind of another one that we should be paying attention to.
Adobe's a really interesting one for me because, surprise, I use it as a creative and video editor. And one of the funny things I find about the AI disruption comments about Adobe, going to get into this, is that Adobe has actually made a lot of strides in AI within the system.
Okay.
But Adobe's AI has all been focused on how to make creatives' lives better and faster. So you can do what you want to do, but more quickly, but still be a creative instead of letting the AI be the creative. I mean, some will argue, and there definitely are things where you're like, make me this logo, and Adobe will let you do that. But at the same time, they have these amazing like sound editing abilities and all sorts of tools that have been added that make video editing and image editing so much faster. Masking used to spend forever, like going in, penciling out somebody, and now you just click and it does it. So I do think it's a really interesting thing when people say that they're being destroyed by AI when AI have made them so much more powerful in ways that a lot of the free ones are not able to keep up with, like free tools and free versions and the alternatives. So it'll be interesting to see how that all plays out because I do think other free versions and competitors will get there. But right now, like, I wouldn't give up my Adobe license.
Mm-hmm.
I'm still paying for it.
It is, it's one of those, and Acrobat is still the standard, right? Like, we use Acrobat for PDFs all the time. I mean, even just as even as individuals that are not getting it, on a corporate license or things like that. I mean, kind of consumer discretionary is this broad term that's right in the middle of this Venn diagram that touches enterprise software and retail and advertising and all these other things. But it's just right now, more than any other time, I think that there is a pessimistic outlook that these things that people have been using for years, they're just going to stop using them because of AI, because it's so much easier to do out there. And we haven't seen that yet. We certainly have not seen that with Adobe as one example. The fundamentals still look strong. They've kept their retention high and their margins are fantastic. Now, does that maybe change in 2 or 3 years? Yeah, maybe. But if you're only paying, call it 10 or 12 times free cash flow for a company that's converting 40 cents of every dollar into cash flow already, I mean, you've got to pay attention that maybe it's not going to be as disrupted as badly as the market is pricing a company like that right now.
It's an interesting idea that people are just going to stop doing things because of AI when it's, to me, people are going to change how they do things with AI. And that seems to be a very missed point. And I could be wrong, but it's a very fascinating view of the world.
Brands and habits are hard to break. And I think that's the heart of consumer discretionary at its core. Again, kind of a neat sector. I think it's one that we need to be paying attention to. We always want to talk about the Palantirs and the Nvidias and the sexy high flyer companies out there. This is an unsexy sector that has just kind of been left for dead. And I think that, in my opinion, there are some pretty good drivers that are going to push this one higher next year. So another promotion there for consumer discretionary, as we kind of wrap up this show. I do think this is a sector that's primed for a comeback next year. And the February 2026 recommendation shows you that. So this is going to be a fun month coming up. As we finish up Groundhog Day here today, we've got February on the calendar coming up. We've got another one with Emmett Savage on Wednesday. He's going to be talking about yet another cool technology company. This one's called Computer Modeling Group, one that might be off the radar of a lot of companies. We're going to talk about that one on Wednesday. The following week, we're going to be talking about semiconductors with Chip Stock Investor. Going to be having a neat discussion on that. We're going to talk about biotech innovation with former 7investing advisor Manisha Samy next Friday as well. We're going to go on and talk with John Rotanti, Jeff Fisher, and Eric Bleeker later this month as well. Some really good guests on the program. I'm excited to have all of them here on 7 Investing Live in February. And so until that time, today is February the 2nd. Again, my name's Simon Erickson. I'd encourage you to check out 7investing.com/subscribe if you'd like to see all of our premium content. In the meantime, have a great week. Be kind to one another and be safe. And we'll see you again on Wednesday.